Right, so the next section of this lesson is cost behaviors. So the first cost behavior we are going to run through are fixed costs. So very, very simply, fixed costs are costs that do not vary depending on output. So if you can imagine a factory that produces, we'll go back to the smartphone factory example. If it produces smartphones, fixed costs will remain the same whether the factory produces 100,000 smartphones or 200,000 or 300,000. How many smartphones they produce, the fixed costs will remain the same. And you can see that in the graph that the total fixed costs remain flat even when output increases. So you can see the definition just underneath the graph, not affected by changes in production levels. So that's the key concept behind fixed costs. And examples of fixed costs would be rent or a supervisor's salary or even straight line depreciation. And the reason why these are good examples is because if you can imagine a factory, the rent is not going to change depending on how many units that are being produced. So it's completely independent from output and therefore it's a fixed cost. So the next cost behavior that we're going to run through are variable costs. So variable costs are the complete opposite to fixed costs. Variable costs change directly in relation to output. So what do we mean by this? Well, if we take the example of the smartphone manufacturer, if the units produced increase, so will variable costs. They increase or decrease depending on changes in output. And you can see in the graph there, as output increases, so do variable costs, total variable costs. And the definition there, costs that vary directly in line with changes in level of activity. So that's again just reiterating the point that I said earlier, that if we increase output, so will the cost of variable costs. So they'll increase in line with that output increase. And it's expressed, so total variable costs are expressed as the variable cost per unit by the number of units. So this very simply says that our total variable costs, whether it's for a period or it's for a year or a few years, it's the variable cost per unit. So the variable cost for each unit produced by the number of units that are produced in that same period. That gives us the total variable cost for the period. So we're just going to run through another sort of category within cost behaviors, and that's stepped costs. So step costs are a little bit more complicated, but very simply, a step cost is a cost that increases within a certain range of activity. So what I'm sort of saying there is that they don't directly change in relation to each unit being produced, but they might change if a large amount of units are produced or if there's a large decrease in units being produced. And so an example of that might be the cost of supervisors. So we don't need an extra supervisor for each unit produced. In most, if you can sort of consider the smartphone example again, if we produce an extra smartphone in the period, we don't need an extra supervisor. But if we increase the production to say 30,000 or 40,000, we might need an extra supervisor to look after maybe extra shifts or extra employees that are required to make that smartphone. So you can see that within different ranges of activities, so different ranges of output, the cost of hiring or salaries related to supervisors increases or decreases if the activity reduces within the period. So a stepped cost changes in relation to a range of activity. It's not directly related to each unit produced, but a quantity of units being produced. So that's why it's called a stepped cost. It's like if you can imagine a stairs, it goes up at a certain range and then flat and then up again, and it's continually going up like a set of stairs. That's what the graph looks like. Then the other cost behavior that we're going to look at are semi-variable costs. So these very simply are a cost that has a fixed and a variable element. So it's like putting variable and fixed costs together. So an example of this would be electricity. It's a classic example where there's a variable element. So obviously the more units that we produced, that's going to have a impact on the cost of electricity, especially if the process involves heavy use of electronic machinery. So a good example is like a car manufacturer. They use heavy industry that requires a lot of electricity. So if more cars are produced, then that cost is going to go up. There's also a fixed cost element to electricity in some circumstances. So in some jurisdictions, there are metering charges that are the same every month. So this is paying for the electricity meter that you have outside your organization, that people can record the amount of electricity you're using. And there might also be environmental taxes that could be the same each period. These would be fixed costs because they're completely unrelated to the amount of units that are being produced. So electricity is a good example of a semi-variable cost. So we're just going to move on to an example to make sure all that's clear. So in this example, the company is called Brunswick PLC. So it's a large car manufacturer. So going back to that example again, the organization uses a large amount of electricity per month, which is primarily driven by the amount of cars produced. Brunswick are charged per kilowatt, so they're charged per kilowatt used in the period. There is a surcharge each month that includes the cost of metering and environmental taxes. The surcharge is the same amount each period. So what category would the cost of electricity fit under for Brunswick PLC? Well, we have four choices again. So we have stepped cost, fixed cost, variable cost, or semi-variable cost. So if we just take the question piece by piece again, and this is always a good way to kind of, I suppose, generate an answer if you're looking at these types of questions, is to just take all the clues in the question and, go through a process of elimination, look at each answer and sort of evaluate and see, does that fit the criteria of the question? So if we look at the question, it has, the organization uses a large amount of electricity per month, which is driven by the amount of cars produced. So that sounds like a variable cost. So the more cars that are being manufactured, the higher the cost of electricity is. So that's very much a variable cost. But the question also mentions that there is a surcharge, so an extra charge each month, which includes the cost of metering and environmental taxes. So the surcharge, it says in the question, is the same amount each period. So if it's the same amount each period, then it's fixed because it's not related to the amount of units being produced. Because we have a variable and a fixed element in the question, we can say that this is a semi-variable cost. Now, in this case, it's quite straightforward, but if there had just been no surcharge, that would have been a variable cost, or if we had just included the surcharge, it would have been a fixed cost. But because there's a fixed and variable element, it is a semi-variable cost. And the solution there just basically reiterates everything I'm saying. The variable and the fixed element combined, and obviously that the variable element is related to the amount of units produced, and the surcharge is fixed, so it's not related to the amount of units produced. So that gives a clue that it's a fixed cost, and so we combine the two together and we get a semi-variable cost.